it's very, very flexible, I guess is the answer here.
Because with a 1031 exchange, you have that time limit, and then you're under the gun, right? You've got to find the other new properties that you're going to be buying, like in kind, upgrading, so to speak. Talk about the time limit again with this trust. Maybe
yes.
Dive a little deeper.
So the intent is optimal timing. So we have a saying around here that goes, we want you to buy at optimal timing. What is optimal timing? Well, it's when it makes sense for you. It's when you find a deal, right? It's maybe when the market shifts. It's maybe when your lifestyle changes. Right now I have 5 young kids, and my strategy is more to be passive with other operators who are focused on that while I focus on my business and my family. Right? So my optimal time is different from someone else's optimal time. Maybe that person who owns 25 homes and he's built a portfolio up for 30 years, maybe his optimal time is to retire or buy when the market makes sense. He went through the 08 crisis, so he could slowly, because there's no time limit with the Deferred Sales Trust. We are a separate tax code. We are IRC 453 versus the 1031 exchange, IRC 1031, right, which has the 45 days to identify and 180 days to close. And generally, you have to replace equal or greater value, which means you have to replace the debt. Also, the entity must move. So you have all these rules to follow for the 1031 exchange, right? Whereas the IRC 453 is very flexible. It's an installment sale that doesn't have those rules. So you could just slowly sell multiple properties as you see fit when you find the buyer and pay off the debt, move them into the trust. So you're getting your powder dry, you're getting your cash on the sidelines, you're getting diversified, right? And that's the other part. Diversification is not just into other asset classes, but perhaps it's with other operators in different geographical locations across the US. Generally, the 1031 exchange, your people are picking the 3 property rule, which means you basically have 3 properties to choose. And generally, they're also staying in the same product type they've always been in. And generally, it's the same geographical location. So they're not as diversified as they could be if they said, okay, Clayton, I have $1 million in my trust now. It looks like you have a nice deal in Florida. We'll put $100,000 there. It looks like you have a nice deal in New York. We'll put $100,000 there. And it could be different product types. Maybe you have someone who does mobile home parks or multifamily or senior housing. And then you have the single family one. So you can diversify outside of your commercial real estate holdings whenever you want, all tax deferred without any debt in necessarily your name, unless you're buying that deal as yourself and putting the debt in your name, which is different. But it's very, very flexible, I guess is the answer here.